Remember when we had to rewind tapes? Man, those were the days, weren't they? The satisfying whir of the VCR, the anticipation building as you waited to see your favorite movie or re-listen to that killer song on your mixtape. It feels like a lifetime ago, a different world entirely. We were so patient back then, weren't we? Waiting was just part of the experience. Yeah, this is harder. Navigating the financial landscape for our kids today, it's a whole different ballgame. Forget rewinding, there's no going back to the good old days, and frankly, those days weren't always that good for everyone. The challenges our kids face are complex, systemic, and often feel insurmountable. It's not just about pulling yourself up by your bootstraps anymore. Sometimes there aren't even any bootstraps to grab onto. Hey Gen X, we're the ones who grew up with pagers, those little devices that beeped and vibrated, signaling a need to connect, a simpler time when communication wasn't constant and immediate. We remember the thrill of finding a payphone and calling back, hoping it was important. Mixtapes, carefully curated collections of songs, painstakingly recorded and personalized for that special someone. Hours spent crafting the perfect track list, agonizing over the right order, a true labor of love. And blockbuster nights. The Friday night ritual of browsing the aisles, searching for the perfect movie, the excitement of a new release, the shared experience of watching it together as a family. Remember the late fees? We were latchkey kids, figuring things out on our own, coming home to an empty house, making our own snacks, entertaining ourselves until our parents got home from work. It instilled a sense of independence and self-reliance in us, resourceful, independent, and a little skeptical. We learned to question authority, to think for ourselves, to not blindly accept everything we were told. It's a trait that has served us well. Now the world's changed. Technology has transformed every aspect of our lives, from how we communicate to how we work to how we consume information. The pace of change is relentless, and it can be hard to keep up. Our kids, Millennials and Gen Z, face economic hurdles we never imagined. The playing field is uneven, the rules are different, and the challenges are far greater than what we experienced. They're entering a world with unprecedented levels of debt and economic uncertainty. They're up against student debt, a burden that can weigh them down for decades, delaying major life milestones like buying a home or starting a family. The cost of education has skyrocketed, making it harder than ever to get ahead. Sky-high living costs, making it difficult to save money or even make ends meet. Rent is through the roof, groceries are expensive, and wages haven't kept pace. And a housing market that feels out of reach. The dream of homeownership seems like a distant fantasy for many young people, priced out by soaring property values and stagnant wages. We might wonder why they can't just pull themselves up, but the rules have changed. The old formulas for success don't apply anymore. The economy is different, the job market is different, and the challenges are different. We survived dial-up and Y2K technological hurdles that seemed daunting at the time, but now seem almost quaint in comparison. We adapted and overcame, and we can help our kids do the same. And now we're the bank of mom and dad. We're in a position to offer financial support to our kids, whether it's helping with rent, paying off student loans, or contributing to a down payment on a house. It's strange. Once rebels, now we're the ones with the 401 KAs and the gray hair. We've come a long way, and we've learned a lot along the way. We have a responsibility to share our knowledge and experience with the next generation. Helping our kids isn't coddling, it's recognizing the game is different. It's about providing them with the resources and support they need to navigate a challenging world. It's about leveling the playing field and giving them a fair chance to succeed. The old playbook doesn't work anymore. The traditional advice about saving money and working hard is still important, but it's not enough. We need to find new strategies and solutions to help our kids achieve their financial goals. So, let's roll up our sleeves and figure out how to give our kids a real shot at homeownership. Let's explore different options, from co-signing loans to providing down payment assistance to helping them find affordable housing. That's what Gen X does best, adapt and help the next generation survive. We're resourceful, resilient, and we're not afraid to challenge the status quo. We can use our skills and experience to make a real difference in the lives of our kids and help them build a brighter future. It's easy to fall into the trap of blaming the younger generation for their struggles, especially when it comes to homeownership. We hear phrases like lazy millennials or entitled Gen Z, but these are gross oversimplifications that completely miss the mark. Your kids aren't lazy or entitled for struggling to buy a house. It's not a matter of lacking work ethic or ambition. The truth is, the economic landscape is nothing like it was in the 90s. We often look back with rose-tinted glasses, forgetting the challenges of previous generations. But the stark reality is that the financial playing field has drastically changed, making it significantly harder for young people to achieve the same milestones their parents and grandparents did. Back then, a decent job could get you a starter home. The path to homeownership felt more accessible, more attainable. It was a realistic goal for many young adults entering the workforce. The dream of owning a home was within reach, a symbol of stability and the cornerstone of building a future. Back then, after a few years of saving, a down payment felt manageable. The financial burden wasn't as overwhelming. Saving felt like a tangible path towards achieving that goal of homeownership. It was a time when diligent saving could actually make a significant difference. Now, home prices have skyrocketed, reaching levels that are simply unattainable for many young people. The dream of owning a home feels increasingly out of reach, replaced by the harsh reality of inflated prices and a competitive market. It's a situation that leaves many feeling discouraged and hopeless. But wages haven't kept up. While the cost of everything else has soared, salaries have stagnated, creating a widening gap between income and expenses. This disparity makes it incredibly difficult for young people to save for a down payment or even qualify for a mortgage. The economic realities are stacked against them. The down payment is a mountain, not a molehill. It's a massive financial hurdle that requires years of dedicated saving, often an impossible feat given the other financial pressures they face. What was once a manageable sum has now become a seemingly insurmountable obstacle. Student loan debt is crushing, a burden that weighs heavily on the shoulders of recent graduates. It's a financial albatross that hinders their ability to save, invest, and build a future. The sheer magnitude of the debt can be paralyzing, much bigger than what we faced. The cost of education has exploded, leaving young people with significantly larger debts than previous generations. This financial burden impacts their ability to make major life decisions, including buying a home. The playing field is simply not level. Many grads owe as much as a mortgage before they even start house hunting. Imagine starting your adult life already saddled with a debt equivalent to the cost of a home. It's a daunting prospect that significantly delays or even eliminates the possibility of homeownership. Before they even start house hunting, they're already starting behind, with a massive financial obligation hanging over their heads. The dream of owning a home feels like a distant fantasy, overshadowed by the reality of their debt. Lenders see that debt and hesitate. The high debt-to-income ratio makes it difficult to qualify for a mortgage, even with a good credit score. Lenders are wary of the risk, further hindering their chances of achieving homeownership. Add in the relentless rise in living costs. Everything from basic necessities to everyday expenses is becoming more expensive. Inflation is eroding their purchasing power, making it even harder to save for the future. The cost of simply existing is skyrocketing. Groceries, the cost of feeding themselves and their families, is constantly increasing. The grocery bill seems to climb higher every week, leaving less money for other essential expenses. Gas, just getting to work or running errands, is becoming a significant financial burden. The fluctuating gas prices add another layer of uncertainty to their already strained budgets. Insurance, whether it's car, health, or renter's insurance, the premiums keep climbing, eating into their disposable income. Protecting themselves and their assets is becoming increasingly expensive. And there's little left to save. After covering all the essential expenses, there's barely anything left to put aside for a down payment or future investments. The dream of building wealth feels increasingly unattainable. Rent eats up their paychecks, consuming a significant portion of their income each month. The high cost of rent leaves them with little financial flexibility and makes it difficult to save for the future, leaving them stuck in a cycle with no equity. They're essentially paying off someone else's mortgage without building any wealth for themselves. It's a frustrating and disheartening situation. It's not about avocado toast. That's a tired and dismissive stereotype. It's a convenient way to avoid addressing the real systemic issues that are preventing young people from achieving financial stability. It's about math that just doesn't work. The numbers simply don't add up. The cost of living is too high, wages are too low, and debt is too overwhelming. It's a broken system that needs to be addressed. The rental trap is real, and it's not their fault. They're caught in a system that makes it incredibly difficult to escape. It's a systemic issue that requires systemic solutions. They're paying more for less, sacrificing space and comfort for the sake of affordability. They're often forced to live in cramped apartments or share living spaces with roommates just to make ends meet. And the dream of homeownership keeps slipping away. It feels like a distant and unattainable goal, replaced by the harsh reality of rising prices and stagnant wages. The hope of building a future feels increasingly dim. This is the reality for millions of hardworking young people. They're not lazy or entitled, they're simply facing unprecedented economic challenges. They deserve our understanding and support. Understanding this is the first step to helping them break free. By acknowledging the systemic issues and offering support, we can empower them to navigate these challenges and build a brighter future. It starts with empathy and a willingness to listen. The dream of homeownership feels increasingly out of reach for many young adults today. Sky-high prices, rising interest rates, and the ever-present challenge of saving for a down payment create a formidable barrier. As parents, we naturally want to help our children achieve their goals and secure their future. But how can we provide meaningful support without jeopardizing our own financial well-being? So what can we do? The simplest way: gift your child a down payment. This can be a game changer, providing the necessary funds to overcome that initial financial hurdle. It's a direct and impactful way to assist them in entering the housing market. It's a gift, a true act of generosity, offered with love and support. It's not a loan, no strings attached. This is crucial. The understanding should be clear. This money is a gift, not an obligation to be repaid. This avoids potential strain on your relationship down the line. This leapfrogs the biggest hurdle for first-time buyers. That substantial down payment can often be the biggest obstacle standing between them and their dream home. By providing this gift, you're essentially clearing the path for them to achieve their goals sooner. Lenders allow gifted funds. In fact, it's a fairly common practice. But you need documentation. Transparency is key when dealing with financial institutions. A gift letter stating it's not a loan. This is a standard form that clarifies the nature of the funds being provided. It protects both you and your child. No secret envelopes, keep it official. All transactions should be documented and transparent. This ensures compliance with lending regulations and avoids any potential complications. The beauty? There are several advantages to this approach. You're not on the loan or title. This means you have no legal or financial responsibility for the property, and your credit isn't at risk. Their mortgage payments won't affect your credit score in any way. You give them a boost, then step back. You've provided the initial support they need, allowing them to build their own financial future independently. But only do this if you can afford it. This is paramount. Never compromise your own financial security for the sake of helping your children. Don't dip into your retirement. Your retirement savings should be untouchable. Raiding those funds can have serious long-term consequences for your own financial well-being. If you have extra savings, funds that you won't need for your own expenses or future plans, a down payment gift can change your child's life. It can provide them with stability, security, and a sense of accomplishment. It's a direct, powerful way to help them start building wealth. Homeownership is a cornerstone of wealth creation, and you're giving them a significant head start. Sometimes a little help at the right time makes all the difference. It can be the catalyst that propels them towards a brighter future, filled with opportunity and financial security. If your kid has a down payment but shaky credit or income, consider co-signing their loan. You're vouching for them. If they can't pay, you're on the hook. Your credit and financial history help them qualify and maybe get a better rate. But this is serious. You're legally responsible for the loan. Missed payments hurt your credit too. Only co-sign if you're confident in their discipline and your own ability to cover payments if needed. Have an honest talk about budgets and backup plans. If you have doubts, don't do it. Co-signing is generous, but it's a big risk. Know what you're signing up for. Want to be even more involved? Buy the house together. You're both on the mortgage and the title. True co-owners. This works well for multi-generational living or pooling resources for a better property. You share costs, responsibilities, and decisions. But set clear agreements from the start. Who pays what, how repairs are handled, and what happens if someone wants out. Get everything in writing with a lawyer. Plan for the what-ifs. Job changes, marriage, selling. Co-ownership can build family wealth, but only with clear communication and legal clarity. Think partnership, not just property. If you've built up home equity, you can use it to help your kids. Options include a home equity line of credit, HELOC, or a cash-out refinance. A HELOC lets you borrow as needed. A cash-out refinance gives you a lump sum. This can free up cash for a down payment without selling your home. Interest rates are usually lower than personal loans, but remember, you're putting your own home on the line. If you can't make the new payments, you risk foreclosure. Only use this strategy if your finances are rock solid. Don't gamble your sanctuary for anyone, not even your kids. Use home equity carefully and with a clear plan. Feeling business-minded? Become your kid's private lender. Instead of gifting or co-signing, you loan them the money, formally. Set the terms, interest rate, and repayment schedule. Draft a legal promissory note and secure the loan with a lien, just like a bank. This keeps wealth in the family and can offer better terms than a commercial lender. But treat it like a business deal. No handshake agreements. The risk? Mixing family and money can strain relationships if things go wrong. Clear documentation protects everyone. If you can keep it professional, this can be a win-win. But be honest, can you enforce the terms if needed? Here's what not to do. Never drain your retirement to help your kids buy a house. Your 401k and IRA are off limits. Protect your future first. Your kids can borrow for a house. You can't borrow for retirement. Don't become a burden later because you sacrificed your own security. Also, never skip the paperwork. Gift letters, promissory notes, co-ownership agreements. Get it all in writing. It's not about trust. It's about protecting everyone. Life throws curveballs. Divorce, job loss, emergencies. Documentation keeps intentions clear and everyone safe. And don't enable bad habits. If your child isn't financially responsible, money won't fix it. Homeownership is more than a mortgage. It's taxes, repairs, and discipline. Sometimes the best help is financial education, not cash. Helping your child buy a house is more than a transaction. It's a teaching moment. Use this chance to pass on real-world wisdom. Talk openly about budgeting, true costs, and the responsibilities of owning a home. Go beyond the mortgage. Cover taxes, insurance, utilities, and maintenance. Stress the need for a home repair fund. Teach basic DIY skills. How to shut off water, clean gutters, change filters. These skills save money and build confidence, instill pride and responsibility. Homeownership is active, not passive. Empower them to be stewards, not just residents. Pair your financial help with practical guidance. The goal, help them climb the property ladder on their own. You're giving them tools for life, not just a house. That's the real legacy. The housing market is tough, but Gen X is tougher. You don't need millions, just a plan and the right approach. Whether you gift, co-sign, co-own, tap equity, or lend, choose what fits your family and finances. There's no one-size-fits-all answer. Start with honest conversations about goals and limits. Consult a financial advisor or mortgage expert for guidance. Use online tools and legal help to protect everyone. Don't go it alone. Get expert advice. This is about more than real estate. It's about family and values. Leverage your stability to build a foundation for your kids. Pass on responsibility, planning, and perseverance. Gen X, you've got what it takes to help your kids build a future. Now go make it happen.